While filing your ITR, beware. These mistakes can alert the taxman. Here are 7 red flags that you must avoid while filing your income tax return. These discrepancies can alert the tax department and fetch you a tax notice, which you don't want. Number 1. Discrepancy in declared income and actual income. Form 16 from your employer has 2 parts, Part A and B. Part A has the details of the payments made to the employee and the tax deducted on it. Part B gives a detailed breakup of the income of the employee and shows how the tax has been calculated after taking into account all exemptions and deductions. Now, if there is a significant mismatch between these two, that is the actual income mentioned in Part A and the declared income mentioned in Part B, you can expect to receive a notice from the tax department seeking an explanation. Point number 2. No interest declared in the tax form. Every taxpayer earns some interest during the year. These could be from bank fixed deposits, recurring deposits, national savings certificates, or even your bank saving account. A lot of us miss out on this information while filing our tax return, but this is something which must be reported. Even though interest earned up to Rs 10,000 on your savings bank account is tax-free, it still needs to be included in your total income for the year. Point number 3. Not paying additional tax on interest. Many taxpayers believe that they do not need to pay tax if TDS has already been deducted. The TDS, however, is only 10% of your income. If the investor falls in a higher tax slab, he needs to pay additional tax. Some taxpayers think that the fixed deposits remain hidden, but the TDS is a clear giveaway. This will show up in your Form 26AS along with the interest income earned by you during the financial year. Point number 4. Tax paid but ITR not filed. Every individual must file his ITR if his income during the financial year exceeds the basic exemption limit. Even if the basic tax liability is zero after claiming all deductions, the income tax return must still be filed. For a quick recap, the basic exemption limit for a general taxpayer is Rs 2.5 lakh. That for a senior citizen, that is someone who is above 60 years of age, is Rs 3 lakh. And for someone who is a super senior citizen, that is above 80 years of age, it's Rs 5 lakh. Point number 5. Not reporting your income from the previous employer. Now this is a common problem. There must be some taxpayers who have switched jobs during the financial year, in which case both their employers would have given them Section 80C and other tax benefits. If he or she ignores the income from the previous employer, his or her tax liability will be very low, but it won't be long before this discrepancy is detected by the department. The missing income from the previous employer will be detected if TDS has been deposited on the taxpayer's behalf along with his PAN and other details. Point number 6. Sudden drop in income. There are many reasons why a taxpayer's income might drop suddenly, but this will immediately alert the tax department. Though this is more common with businessmen and traders, even general salary taxpayers may see sudden drops in income due to many reasons like taking a sabbatical during the financial year, leave without pay, or a job loss. More often, this could be because he or she changed jobs mid-year and declared income from only one employer. Point number 7. The exemptions sought are high. The tax department hates giving out refunds, and suspicions are obviously aroused if you claim too big a refund in your return. Taxpayers with significant refund claims are likely to receive notices from the tax department asking them to substantiate these claims. While this is also usually the case with businessmen and traders, a salaried taxpayer may also find himself in such a situation if he has not furnished the proof of his tax-saving investments and other deductions to his employer on time. So taxpayers, these were just the don'ts. For all the do's, log on to edwealth.co and keep watching this space.